It wasn't a victory over inflation. It wasn't a sign of economic resilience. It wasn't even a merciful reprieve for the consumer. It was the mechanical limit of a debt-based system hitting a wall. The central bank has paused, but history suggests this is not the end. It is merely the eye of the storm. The pattern is unmistakable. The arithmetic is merciless. When a monetary authority tightens credit to save the currency, then suddenly stops to save the system, it rarely signals a soft landing. It signals that something deep in the financial plumbing has broken. We have seen this specific sequence play out before. We saw it in the marble halls of Rome. We saw it in the imperial courts of Madrid. We saw it in the fading light of the British Empire. The mechanics are always the same. First comes the peak dominance, then the unsustainable imperial costs, then the chosen monetary shortcut, followed by the inevitable fracture. Consider the Roman Empire in the 1st century. The Pax Romana was the peak, but the costs of maintaining the legions were absolute. By 64 AD, the Emperor Nero faced a budget crisis. He could not raise taxes without revolt. He could not cut spending without invasion. So he chose the shortcut. He paused the discipline of the silver standard. He collected the denarius coins. He melted them down. He reduced the silver purity from 100% to roughly 90%. He reissued the coins and pocketed the difference. It seemed like a brilliant solution. Liquidity returned to the market. Soldiers were paid. The games continued. But the signal had been sent. The currency was no longer a store of value. It was a political tool. A centurion stationed in Gaul noticed the change first. His pay was the same, but the wheat and wine he bought cost more. The flight into hard assets began slowly. Then all at once, land prices in the provinces spiked. The middle class was priced out of existence. Social fracture followed. The pause in discipline did not save the empire. It merely delayed the reckoning. Just like Rome, the Spanish Empire in the 16th century faced the same wall. King Philip II presided over the greatest power on earth, but his wars in the Netherlands were a financial black hole. The cost of empire exceeded the tax base. The shortcut this time was not debasement, but debt and silver. Spain relied on massive inflows of silver from the Americas to pay its creditors. But when the costs spiked, the crown hit a limit. In 1557, Philip effectively paused his debt payments. It was the first sovereign default of the era. He converted short-term loans into long-term bonds called juros. It was a forced restructuring, a pause in liquidity to save the treasury. The immediate crisis was averted, but the influx of silver combined with the loss of creditworthiness ignited the price revolution. Prices in Spain multiplied. A merchant in Seville found that despite the empire's wealth, he could not afford local wool. Spanish industry collapsed because it was cheaper to import goods than to make them. The gold and silver flowed right through Spain and into the hands of its enemies. The middle class was hollowed out. The empire began its long, slow slide into irrelevance. The pause in payments bought time, but it sold the future, just like Spain. The British Empire in the 20th century offers the most direct parallel to our modern moment. By the 1960s, Britain was struggling to maintain its global standing. The pound sterling was the reserve currency of the Commonwealth, but the domestic economy was rotting. British policymakers engaged in a strategy known as stop-go. When inflation rose and the pound weakened, they hit the brakes. They hiked interest rates to defend the currency, but as soon as unemployment ticked up, the political pressure became unbearable. So they paused. Then they cut rates. They prioritized employment over sound money. This happened repeatedly throughout the 1960s and 70s. Each pause was greeted with relief by the stock market, but each pause eroded credibility. In 1967, the dam broke. They could no longer defend the peg. The pound was devalued against the dollar. A dock worker in Liverpool saw his savings evaporate in real terms, even as his nominal wages rose. The resulting inflation of the 1970s was not an accident. It was the direct result of pausing the fight against inflation too early. The incentive was to keep the game going. The result was the winter of discontent and a complete restructuring of the British economy. The pattern repeats in 7 distinct stages. And the historical record shows that we are currently moving through the most critical phase of this sequence. Stage 1 is expansion, where cheap credit fuels growth and asset prices rise, creating an illusion of permanent prosperity. Stage 2 is overextension, where debt levels rise faster than income and the system becomes fragile. Stage 3 is the tightening, where the central authority attempts to rein in the excess by raising rates or restricting credit, causing immediate stress in the financial system. Stage 4 is the break, where a key component of the economy, be it the bond market, the banking sector, or sovereign debt, begins to crack under the pressure of higher costs. This leads to Stage 5, the pause. This is the moment where the authority blinks. Faced with the choice between defending the currency or saving the system from immediate collapse, they choose the system. They stop tightening. They promise stability. Because the structural issues were never solved and the currency was sacrificed to save the debt. Inflation returns with greater ferocity, or the currency loses significant purchasing power. Finally, Stage 7 is the collapse and reset, where the imbalances are cleared not by policy, but by market force, leading to a new monetary standard. The central bank cannot allow the sovereign debt market to freeze, nor can it allow a systemic banking failure. Under these constraints, the rational move for the policymaker is to pause, to provide liquidity, and to hope that inflation subsides on its own. Proponents point to robust labor numbers and resilient consumer spending. However, this view ignores the lag effects of monetary policy and a sheer arithmetic of debt service. When debt to GDP ratios are at historical highs, the interest cost alone consumes a massive percentage of tax revenue. The arithmetic dictates that rates cannot stay high enough to kill inflation without causing a fiscal spiral. The pause is not a sign of victory. It is an admission that the tightening cycle has hit its mathematical limit. History indicates this leads to one of three endgames. The first is a controlled decline, similar to post-war Britain, where living standards slowly erode. The currency loses value consistently, and the middle class is quietly priced out of asset ownership over decades. The second is a chaotic collapse, similar to the French assignat crisis or Weimar Germany, where the loss of confidence is sudden, leading to hyperinflation and social upheaval. The third is a reset and restructure, similar to the 1944 Bretton Woods Agreement, where the rules of the game are rewritten, currencies are repegged or replaced, and debt is reorganized, often at the expense of savers and bondholders. The only variable is timing and pain. Subscribe to the channel, study the history of currency devaluations. Focus on acquiring skills that are independent of the financial sector. Build resilience in your local community. Pay attention to the data, not the headlines.